Opendoor Technologies is currently trading at $10.25, showing a modest gain of about 0.39% for the day. The stock has been volatile, trading in a range between $9.91 and $10.49 so far in the session. And while most of the financial media and retail investors are laser-focused on the headline news, the latest whispers from the Federal Reserve about mortgage rates, they are completely missing the subtle yet incredibly significant shift in the underlying mechanics of this stock. The real story isn't about the next 25 basis point hike. It's about the brutal efficiency Opendoor has been forced to learn and the consolidation of power occurring in the iBuying space as weaker hands have been forced to fold. The market sees Opendoor as a simple interest rate proxy, a leaf in the wind of macroeconomic policy. The expectation is straightforward. If rates are high or rising, the housing market freezes, and therefore Opendoor's business model is fundamentally broken. This narrative is easy to understand, fits neatly into a headline, and has been the dominant thesis among traders using platforms from Robinhood to SoFi Invest. But this expectation is colliding with a much more complex and compelling reality. The reality is that the Opendoor of today is not the same company that existed during the zero interest rate frenzy. The past 2 years of a challenging housing market have been a trial by fire, forcing the company to radically overhaul its pricing algorithms, streamline its operations, and manage its inventory with a level of discipline that was previously non-existent. While competitors have vanished, Opendoor has weathered the storm, absorbing market share and refining its process. This isn't just a story about surviving, it's about emerging from a downturn as a leaner, more dominant force. The market is pricing Opendoor for a perpetual housing winter, failing to account for the operational leverage that has been built into the model. They are looking at the storm clouds and ignoring the fact that the company has built a much stronger ship. The disconnect between this perception and the operational reality presents a fascinating dynamic for anyone doing serious investment analysis beyond the surface-level chatter. Looking closer at the recent stock movement, the volume patterns tell a critical part of this story. We're seeing massive trading volumes, far exceeding the 3-month average on days with both significant gains and pullbacks. Today alone, over 106 million shares have already changed hands. This isn't just retail froth. This level of activity suggests a fierce debate between institutional players. On one side, you have funds liquidating positions based on the prevailing fear-based narrative around housing. On the other, you have a quiet accumulation by funds that see the long-term value proposition and the market leader solidifying its position. This is the kind of battle that creates significant price shelves and volatility. We saw the stock test a key support level just under the $10 mark earlier today and bounce sharply, indicating strong buying interest at that psychological level. This isn't random noise, it's the signature of large orders being filled. Portfolios managed through sophisticated platforms like Schwab Intelligent Portfolios or Fidelity Wealth Management, which take a longer-term data-driven approach, are likely paying close attention to these accumulation patterns rather than reacting to the daily news cycle that drives so much of the activity on simpler online investing apps. The performance of Opendoor stock today, while seemingly muted, is a microcosm of this larger battle between the entrenched narrative and the emerging operational truth. For context, it's important to understand what Opendoor actually does. Its business model is known as iBuying, or instant buying. In simple terms, the company uses vast amounts of data and proprietary algorithms to make near-instant cash offers on homes. If the seller accepts, Opendoor buys the property, makes necessary light repairs, and then lists it for sale on the open market, aiming to make a profit on the flip, supplemented by service fees. This model is designed to offer sellers speed and certainty, eliminating the traditional hassles of listing a home, such as showings, staging, and uncertain timelines. During the housing boom, this was a high-growth, high-risk endeavor. The primary risk has always been holding a large inventory of homes on the balance sheet if the market turns. When prices fall, the value of their assets drop, leading to significant losses, which is precisely what the company experienced during the initial rate shock. However, past performance is not indicative of future results, especially when a company has been forced to fundamentally re-engineer its risk management protocols. Older reports will show deep losses tied to inventory write-downs, but more recent earnings calls have focused extensively on contribution margin improvements and faster inventory turnover, metrics that the market seems to be heavily discounting. Many investors who focus on blue-chip stocks like Apple stock or high flyers like Nvidia stock may view Opendoor as too speculative, but they might be underestimating the cyclical nature of the real estate market and Opendoor's improved positioning for the next turn. Looking ahead, the future outlook for Opendoor hinges on this very tension between expectation and reality. The bearish scenario is easy to paint. The Federal Reserve maintains a higher-for-longer stance, mortgage rates remain elevated above 7%, and the housing market stays locked in a low transaction environment. In this world, Opendoor's growth remains constrained, and it struggles to achieve consistent profitability. The pressure on its balance sheet would intensify, and the stock would likely retest its 52-week lows. This is the scenario that the prevailing market expectation is built upon. However, there are multiple alternative scenarios that sophisticated investors using platforms like interactive brokers are modeling out. The bull case, for instance, doesn't even require a return to 3% mortgage rates. A simple stabilization of rates in the 6 to 6.5% range could be a massive catalyst. Such a stabilization would unlock significant pent-up demand from both buyers and sellers. For Opendoor, this would not only increase transaction volume but also improve the accuracy of its pricing models in a more predictable market. Having survived the worst of the downturn, the company would be in a prime position to capture an outsized share of this returning volume given the reduced competition. Furthermore, the company's focus on ancillary services like title, escrow, and financing represents a significant and often overlooked opportunity to increase revenue per transaction. This is a classic land and expand strategy. As they become the primary facilitator of the real estate transaction, they can layer on these higher margin services. The market today values Opendoor almost exclusively as a home flipper, not as a potential fintech platform for residential real estate. This is another critical area where the reality of the business strategy exceeds the market's narrow expectation. The risk, of course, remains execution. The company must continue to manage its inventory flawlessly and prove that it can generate consistent positive contribution margins even in a flat market. It has to demonstrate that its algorithmic pricing advantage is real and sustainable. Comment below on what you think is the biggest risk for Opendoor's business model over the next 2 years. Is it interest rates, competition, or something else entirely? Many traders using Fidelity Investments or other major online investment platforms are debating this very question, trying to weigh the macroeconomic headwinds against the company's specific improvements. In conclusion, the story of Opendoor Technologies is a classic case of expectation versus reality. The market's expectation is that the company is a simple, highly leveraged bet on a falling interest rate environment, a narrative that has kept many potential investors sidelined. The stock's chart is seen as nothing more than an inverse reflection of the 30-year mortgage rate. The deeper reality, however, is that of a market leader forged in the crucible of a historic housing downturn. It has become a more disciplined, operationally efficient company with a more resilient business model and a clearer path to dominating its niche. The intense volume and price action we are witnessing are the market slowly and painfully beginning to process this divergence. The reality of its strengthened market position and refined operational model is starting to challenge the simplistic, fear-driven expectation. While the macroeconomic environment will undoubtedly continue to play a major role, the company's fate is no longer solely in the hands of the Fed. It is now increasingly in its own, and for the discerning investor, that is a far more interesting and potentially rewarding proposition to analyze than the headlines would suggest.